Hello everybody. Welcome to the lecture series on BCG Matrix. This particular video is about BCG Matrix, which is one of the strategic frameworks that becomes very essential for organizations as far as their decision making is concerned. So this is again about charting a course between the opportunity and risk like the answers matrix. So why do you think it's important to understand business portfolio? So why is portfolio analysis important? One, in the current business environment, it's important for the brands to know which product is contributing to their growth, which product is supporting the growth. Second, doing a strategic portfolio analysis will be of help to brands in making informed decisions about their investments, innovation, divestments, etc. So, doing a thorough portfolio analysis would give suggestive ideas to a brand on whether they can invest or divest in a product or should they innovate about the existing product. So today we will discuss about how BCG Matrix contributes to these critical choices. The BCG Matrix was developed by the Boston Consulting Group. This is a framework to assess product portfolios. Having the name of a matrix, this again has a horizontal and vertical axis. The vertical axis is about the market growth rate. So how fast is the growth rate in the market, whether it's high or low. The horizontal axis is about the relative market share, a lower share or a higher share. So the prime purpose of this matrix is to categorize products across 4 different dimensions and take strategic decisions and resource allocation on a strategic ground based on this categorization. So the BCG matrix goes as follows. So there are 4 categories: stars, question marks, cash cows, and dogs. So we have to put in each product in the business line across these categories, and each of these categories has a particular way of behavior. Based on where the product lies, the decision that the businesses will take will also vary. So the first quadrant are stars. Stars are those products that have a higher market share plus have a higher growth rate. So they're growing in the market at a faster rate and have a good market share. So these are those products which will give us significant returns. They have a higher potential for significant returns. However, these products will definitely require substantial investments because they are on the rise in the market. So you need to invest more on these markets in order that the growth is sustained. Also, these products will eventually become cash cows. Like the rate of growth will eventually stop at a particular point, but the product will still continue to have a greater market share, falling into the cash cow category. So once you identify a star product, it's very important that you nurture the product. You do all that is needed to increase the market share of the product. Even the brightest star needs nurturing to maintain their shine. The second quadrants are cash cows. These are products with a higher market share and a lesser growth rate. So the growth rate is less, but market share is more. These products generate a steady and reliable cash flow. These products steadily contribute to the cash flow of the business. They act as the foundation for any reinvestment. So these are the products that bring in money. These are the products that contribute to the positive economic growth. So whatever you earn from this product goes in as investment to the other products. So these are mature products. These are products that have been present with a brand for a very long time. Hence, they are mature products. They have minimal requirements for growth. You need not to grow on the product because it's already grown. It has already reached its saturation and it will continue the same no matter what. So they may not add up to your growth charts, but they definitely power the innovation engine of your business. The third quadrant are question marks, also known as problem childs. These are products that grow rapidly, but their market share is very less. So they have a good potential, but then they require thorough analysis. We'll have to do a proper analysis of why their market share is still less. Decisions must be made appropriately, whether to invest more on these products or to stop investing on these products before the resources drain. So whether or not to invest, the decision has to be taken, investing or divesting. So these products, they pose an intriguing question. They may either transform into a potential star or they may add to the losses more. The fourth quadrant are dogs, which are products with lower market share and lower growth. So these are cash traps. Any cash that goes into this product goes waste. So it's very important that you decide on divesting on dogs, but still, in some cases, these products may act as strategic complementarities. So, like we better let them rest. But suppose we identify these products are going to add on to the strategic advantage, we may still hold on to it. So each quadrant goes with a different strategy. Stars, we need to invest heavily on stars so that we maintain or extend on the leadership that we have in the market. As far as cash cows are concerned, it's all about harvesting profits from the cash cows. We may use the profits that we get from cash cows to fuel innovation in other growth areas. As far as question marks is concerned, we have to take the decision of whether to turn them into stars or divest on them, whether to continue doing that or stop the product. As far as dogs are concerned, we'll definitely have to divest on it or repurpose, provided they have significant contribution to the strategic benefit of the business. As far as risks and rewards are concerned, stars involve higher investments, higher returns, but they also come with higher risks. As far as cash cows are concerned, they have lower risks, they provide steady returns, but the growth potential is limited. With respect to question marks, the outcomes are very uncertain. We do not know whether they'll contribute positively or negatively to the business as well. But we may invest in it goes either ways. We can either invest and grow big, or we may take a risk of draining our resources. As far as dogs are concerned, divesting is a better option. Divesting comes with lower risk. So it's all about how our risk tolerance shapes all the business decisions that are taken. Let us assume a multinational consumer electronics firm. What would be the possible stars, cash cows, question marks, and dogs for this business? Likely the stars may be their flagship smartphones, which have a significant market share. Their cash cows might be like they have already a few laptop models that have a good market share. Anybody who wants to get a laptop will definitely consider this particular brand or model. The question marks might be this brand has come up with wearable technologies and is not very sure of whether these technologies will gain competitive advantage or not. Dogs might be the legacy product, the products that were created when the brand was started. So they are no more required kind of products. So it's important that you strategically allocate resources based on portfolio analysis in order that the business runs with long-term success. So BCG Matrix focuses on current performance and market dynamics, while Ansoff's Matrix explores the future of a product. It's important that we use multiple frameworks complementary. Just because I'm following BCG Matrix, that doesn't mean I need not to follow Ansoff's Matrix or I need not to follow McKinsey's framework. So it's about how we put all these matrices or all these frameworks to use in combination based on the requirement, based on the purpose. We can get into different combinations of these frameworks. So how do you think combining these frameworks will add to the broader strategic advantage? Think about it. So questions for thought. Do you think having a greater market share today would definitely guarantee success in the future? Or do you think continuous innovation is needed to sustain? Second, how do you think market dynamics has an impact on product classification over time? So do you think market dynamics will significantly impact on whether a product is in a cash cow or a dog category? Do you think customer perception has a role to play in transforming a product from question mark to a star? Think about this and come up with your answers. So final takeaways. The BCG Matrix is a diagnostic tool. It helps us to diagnose the products, understand trends, weaknesses, and opportunities across the product portfolio and place our products across the matrix. So based on this, it enables critical decisions like investing, harvesting, or divesting. So strategic success isn't just about managing products in isolation. It's about creating a well-balanced portfolio, a portfolio that gives us long-term economic and strategic benefits. So I hope this video was helpful to you in understanding about BCG Matrix. I'll see you soon with another interesting content. Thanks for watching.